Hey there, Rob Legenhausen. Wanted to talk to you about interest rates. So we finally got the big move from the Fed. The Federal Reserve Open Market Committee just last week went ahead and pulled the trigger on a 0.5 point or 50 basis point rate decline on the federal funds rate. This is a big deal. The federal funds rate is the only rate the Fed controls. All of the other rates in the economy tend to follow that federal funds rate. So think about mortgages, LIBOR, CDs, money market, bonds, all these other rates that kind of are the bloodline of our economy. They all tend to follow that federal funds rate. So it is a big deal and it impacts things. It impacts the economy and it affects your money. Here's how. When we have low interest rates, like we did in COVID, in 2020, the Fed dropped the federal funds rate all the way to zero. And they did that to stimulate the economy, to help get us out of that recession we were in. And it worked. And that's called monetary policy. You see, the Fed has two goals. They have what's called a dual mandate. Number one, it's to keep prices stable, i.e. inflation, in check. And number two, it's to manage unemployment. And so when they move the federal funds rate up or down, they help to manipulate or kind of dictate those two dual mandate goals. Secondly, you have something called quantitative easing, which means when there's a lot of money in the system, and then quantitative tightening, which is taking money out of the system. So in COVID, we had both monetary policy from the Fed that was very accommodative, i.e. they had 0% interest rates, and you had quantitative easing with the Treasury Department printing a lot of money. Those two things are very accommodative for an economy short term. But eventually, if you get too much of that, it will lead to inflation, which is what we got in the end of 21 and into 22. So then the Fed and the Treasury get back together and they sort of pivot. And so then you saw the Fed start to increase interest rates aggressively, which they did for like an 18-month period. And you saw the Treasury begin to tighten up a little bit on the quantitative side. Okay, so now that leads us up to today. We got inflation kind of coming back down to normal where the Fed wants it, and you got things in the macro part of the equation where the Fed feels comfortable enough, and they went ahead and made the call. 50 basis point reduction is what we now have. And if you notice this chart here, I'm going to reference the good news, the way that it impacts your money, is that both bonds and equities tend to do very well in a decreasing rate environment, which is now what we're just starting up. So over the next couple of years, of course, we're going to have volatility. I mean, we have an election coming up. There's some other things kind of under the surface that we're not going to go into here in this video, but you're going to get some volatility. However, bigger picture, the next 1, 3, 5 years should be favorable both for equities and especially for fixed income. We've been positioning client portfolios this year leading up to this event in anticipation of the Fed dropping the rate. And so we've been moving more of our client assets into high quality fixed income, and you're already starting to see the bond market take off and finally pick back up where we'd like to see it. If you have any questions, if you want to talk about interest rates, talk about the election, or you want to talk about how any of this stuff impacts your money, I would love to speak with you. Rob Legenhausen here. Until next time, have an amazing day, and we will talk to you soon. Take care.